Hello guys, welcome back to our YouTube channel. I hope you're doing well. Previously we talked about what is forex trading and its definition, and in today's lesson we shall introduce to you what is a candlestick, what are candlestick patterns, and what they do in the forex market as presented by Forex Space Academy. So let's dive into our lesson for today without wasting much of our time. What is a candlestick? I know you have been asking yourself about what is a candlestick. So in today's lesson, you will understand what is a candlestick in details. So let's start right away. A candlestick is a geographical representation of price movement in the financial markets, commonly used in technical analysis of stocks, forex, commodities, and other tradable instruments. Each candlestick displays the open, high, low, and close price for a specific period of time, which is often displayed on a chart and will give us an idea about the price movement. Candlesticks are flexible and they can be used alone or in combination with other technical tools like moving average, Fibonacci, and many others. I personally trade the market using candlesticks with support and resistance, trend lines, and other technical tools that you learn as we go on in the future lessons. So, how to read candlesticks? So in this lesson or in this slide, you will understand what is a candlestick, how to read the candlestick, and what they represent in the forex market. Let's start with a bullish candlestick. A bullish candlestick is considered to be bullish or is considered a bullish candlestick when the close is above the open, as you can see in the arrow that highlight the closing price and the opening price as represented by green, which represents buyers in the market. Two, a bearish candlestick is represented by color red. I know very many of you know many other colors, but we normally use red and green in the forex market. So it is considered a bearish candlestick when the open is above the close. What do I mean by open and close? I mean the open means the opening price and the close means the closing price in a particular trading period of time. Next, a candlestick has highs and lows to represent where price touched or where price reached in a trading period of time. Next, we have the body represented in a candlestick to mean a trading period. Next, in our slide, we shall talk about candlestick patterns. We have several types of candlestick patterns, but there are basic patterns that are commonly used in the forex market that I will highlight here below. Number one, we have the bullish and bearish engulfing pattern. So the engulfing bar is formed when current candle is fully consumed by the opposite previous candle. What do I mean here? As seen in the bullish engulfing, we have selling power, or we have a bearish candle, as seen in that red candle, and then we see a bullish candle forming, engulfing or consuming the previous selling power, meaning that the buyers have taken control of the market. So when we see a bullish engulfing candle or pattern in the market, we anticipate the buying is going to take place in the next period of trading. On the other hand, we have the bearish engulfing pattern starting from here to that point, and the bearish candle starting from here up to here. And so in that situation, a pattern is considered bearish when the bullish movement is engulfed by the selling movement, as seen in the diagram. Next, we have the doji. Doji candlesticks have the same open and close price. At least their bodies are extremely short. The dodgies should have a very small body that appears as a thin line, as shown in the diagram. In simple terms, the doji happens when buyers and sellers are almost the same. In simple terms, no one controls the market in that particular time. There are different types of doji candlesticks. Here are some of the types. One, we have the standard doji. The standard doji can be bullish or can be bearish, as represented in the diagram. And in that situation, as you can see, the opening price and closing price of the standard doji are at the same point. In simple terms, sellers and buyers in that particular time didn't take a decision, or the market was undecided. Another type of a doji, we have the dragonfly doji, which represents buying in the market since the sellers were rejected, closing at the opening price. In simple terms, a candle or a pattern is considered a dragonfly doji in a situation where there was selling pressure and then buyers rejected the selling pressure, meaning that the buyers were taking control. When we see such a pattern, we are anticipating the buying in the next session. Number 3, we have the gravestone doji, which is the opposite of the dragonfly doji, that represents sellers, as seen in the diagram. When you see where the candle started from and the buyers pushed higher, then sellers pushed the price lower towards the open or exact at the opening price, making it we anticipate selling when we see such a candlestick. Another type of pattern, we have the reversal patterns. And for a pattern to qualify as a reversal pattern, there should be a prior trend to reverse. Bearish reversals require preceding downtrend, and bearish reversals require a prior uptrend. And here are some of the examples. But before we see the examples, let's first understand what is reversal in simple terms. When we are trending upwards, or when the market is trading upwards, or when market is in control of buyers, and we see a significance of selling, it means market is reversing from the uptrend to a downtrend, and the opposite is true. So let's see some of the examples of the reversal patterns. One being the hammer. When we see a hammer, it is a bullish pattern, and it is considered bullish because at the starting place there was selling pressure pushing market lower, and then the buyers came in the market to control the market closing near the open. And when we see such a hammer or such a pattern in the market, we anticipate buying in the next session. 2, we have the inverted hammer. The inverted hammer is also a bullish pattern, as indicated by the opening price being below the closing price. And another thing, that buyers push the market higher and sellers tried to pull lower but couldn't make it bearish or couldn't win the buying power. And when we see such a candle, we anticipate bullish movement. Next, we have the hanging man. The hanging man is also, on the other hand, the bearish candlestick patterns or a bearish reversal pattern, and when we see a hanging man, we anticipate selling because the closing price is below the opening price as seen in the diagram, and what confirms that there is selling pressure is that the market was pushed lower by the sellers, and then the buyers fought harder to win the race, and eventually sellers maintained their pressure, closing as a bearish pattern, hence anticipating selling in the next session. And we have our last reversal pattern being the shooting star, and when we see the shooting star in this situation, we anticipate selling because this is a selling candle or this is a selling pattern, since the opening price is above the closing price. In simple terms, buyers tried to push higher but couldn't make it, and the sellers maintained the. Next, or number 4, we have the tweezer bottom, tweezer tops. When we see these types of patterns, they have 2 candlesticks with nearly matching lows and highs. What do I mean? When you see such candles or those 2 candles forming, the first being bullish and the next being bearish on when market is trending upward, or as seen in the arrow, market was trading in an upward trend shown by the buying pressure, and then we saw a selling pressure forming at the end of an uptrend. It signifies that market is going to change or is going to go in a downtrend. So when we see a tweezer top, we anticipate selling. 2, we have the vice versa, or the tweezer bottom that is seen at the end of a downtrend or is seen when market is trending down, and then we see another buying pressure forming a candle that is equal or near to be the same of the previous candle. So when we see such patterns, we anticipate buying in the next session. We have another type of pattern or candlestick patterns, which is number 5. We have the morning star and the evening star. When we see the morning star, we see all the morning star and evening star. These are patterns that consist of 3 candlesticks and are often used in technical analysis to identify changes in sentiment and potential shift from bearish to bullish and vice versa. So as seen in the diagram, we have the morning star. We are seeing a bearish movement or a candle that is bearish. Then we see a small candle forming. Then we have the third candle being or equal to the first candle. So when we see such 3 candles forming at the end of a downtrend or when market is trending down, and we see such buying pressure coming or forming after these 3 candles, we anticipate that the market is changing direction, or there is going to be a shift from that downtrend to a downtrend. In simple terms, the morning star is a bullish candlestick pattern. So we have the evening star. The evening star is the opposite of a morning star. It is shown by the bullish candlestick or that bullish movement, showing that the market has been an uptrend, and then we see another small candle forming, and then we see the third candle forming to mean that there is going to be a selling pressure. So when we see such candles, either the morning star or the evening star, we anticipate a shift in a trend. We anticipate a shift in a trend, and when you see a morning star, you look for buying opportunity, and when you see an evening star, you look for selling opportunity. We have number 4, being Marabuzo, or our next pattern is Marabuzo, and that is our last candlestick pattern for today. So Marabuzo means that there are no shadows or wicks from the bodies on either the bullish and the bearish candle. So when you see such candles forming in your charts or in the market, you will see that the opening price and the closing price of this first bullish candle, as we highlighted that the green means buying in the forex market, and another thing that the opening price is below the closing price, and we have no wicks in this question, we have no shadows in this question. It means that in this particular time there is a lot of buying pressure. In simple terms, there was no single seller in a particular session as seen in the diagram. When you see the opening price and the closing price are the same, there are no wicks, there are no shadows. And another thing that is commonly known on these Marabuzo candles, when you see them, when market is in a particular place and you see a Marabuzo that is bullish, we anticipate that there is buying in the next session. And when we see a bearish Marabuzo, we anticipate selling. After understanding what a candlestick is, what are different types of candlesticks and their roles in the forex market, in conclusion, seeing a particular candlestick or candlestick pattern, let's say a doji, let's say Marabuzo or a hammer and many others, doesn't necessarily automatically mean to buy or sell in the market or to sell the market. You will need more or multiple confirmations to open a trade. Thanks for watching. We really appreciate your time and your support, being with us every time. And to those that haven't subscribed, remember to subscribe and click the bell icon to always be notified every time we upload a video. Thanks once again. Peace be with you. Ciao, ciao.